Imagine submitting a CMHC application to wait 6 months and then only be denied at the end.
In today's video, we're going to discuss all the things that could go wrong with the CMHC application, what to know, and how to make sure your application gets approved on time the first time.
Hey guys, Aaron and Josh back here with another video, and today we want to touch on some things that could deny your CMHC multifamily application.
Believe it or not, CMHC applications are decently extensive. Think of like a forensic audit of your entire portfolio times 10. So, you are taking on federal debt, and what the lender requires to be able to verify all your information is extensive. As you can imagine, there are a handful of requirements that go into an overall approval. So what we want to do is we want to outline exactly some things that you should focus on so that your file isn't denied by CMHC.
First thing that we're going to touch base on is your personal net worth statement. So for every CMHC loan, you have to be able to show 25% of the loan size. So if you're getting $1 million loan for, let's just say, you got to show $250,000 in liquid assets or net worth. This has to be verifiable. So this isn't your standard net worth statement that you're giving to us just hoping that the lender takes it. No, we got to be able to verify everything that's on here. So for anything that's some sort of like liquid cash asset, stocks, RSPs, investments, we got to be able to show bank statements proving that you have the funds in an account that belongs to you. They will take a look at equity in other properties. This has to be verified with an appraisal. Appraisals, they can be up to a year old as long as the value on that appraisal substantially supports, the equity position in the property. So, this is definitely a big thing. Ideally, we're able to use the majority of your net worth coming from liquidity. When we're taking a look at equity in your subject property, so the one that's being refinanced or the one that's being purchased, it's a little bit tricky. If you're, at 65% loan to value, we might be able to consider, or we should be able to consider, the equity in that property. But if you're, you're 85, 90, 95% loan to value, for one, when you add that insurance premium on top, there's not really any equity there to begin with. But two, they're not likely going to take that equity in that subject property at a higher loan to value. So just keep that in mind.
Yeah, next thing we're going to discuss is overall structure of your deal and capital. So when it comes to raising capital for a project, there are a handful of legitimate ways you can do it. And some of the largest projects in the world are funded through GP/LP structures and mutual fund trusts, which is a phenomenal way to do it if you have the right structure in place. But understanding that CMHC is going to require all your T's are crossed and all your I's are dotted, essentially meaning you can't have silent JV partners who are bringing in capital for projects. When looking at corporate structure, it's important to understand that CMHC is going to require legitimate corporate structure documents. So if you're working with an accountant or working with a lawyer, you're going to want to ensure that the corporate structure is finite and that it's outlined specifically within all the terms and agreements that you have with either your GP, your LP, or your mutual fund trust. It's important to understand that these documents are decently complex, and having a team that really knows how to disseminate these documents or create these documents in a way in which is going to be beneficial, obviously, for you, but for the lender as well, because CMHC is just an insurance company. The lender that is going to be issuing you the capital also needs to be okay with the corporate structure that you are utilizing. So just keep that in mind. If you are planning out and you are looking to talk to a broker before you actually go and do this, have a conversation with your broker, your accountant, and your lawyer to structure it properly, especially if we already know what lender you're going to go to facilitate the CMHC loan.
The next thing we want to touch base on is your portfolio debt servicing. So one of the things you're going to have to fill out for CMHC debt is a portfolio DSCR sheet. If the majority of your portfolio is 1 to 4 unit properties, we will have to put your 1 to 4 unit properties on the sheet. If the majority of your portfolio is like larger multifamily, then we'll be able to just stick with a larger multifamily. But the point here is that CMHC, they take a complete debt servicing look across the portfolio. Ideally, your portfolio is sitting at a 1.1 debt servicing ratio. Now, if your debt servicing is less than that, sitting at 1 or slightly under 1, we should be able to have a good explanation for this as to, why are you transitioning from high interest debt? Maybe it's another property that you're in the middle of just finishing up, and that's going to be going to CMHC as well. But if your portfolio isn't there for every single property, explain to us why, give us the explanation, allow us to explain that to CMHC to use that to help with your file. But CMHC does take a look at your complete portfolio, wanting to see that debt service. Now, depending on how experienced you are at CMHC and how much CMHC debt you carry, if you're a large debt borrower, loans upwards of 70 million, they do actually take a look at your debt servicing closer to 1.4. So keep that in mind depending on where you're at in your investing stage and how much debt you already carry with CMHC.
And let's talk about borrower strength. There's a common misconception with commercial financing and not requiring personal qualification to qualify in. That's kind of right, 50-50. So when it comes to actual qualification of a mortgage on the commercial side, we're looking at a debt service coverage ratio. So how does a building actually qualify? But the other 50% is you as a borrower, or you and your partners as a borrower. How does your portfolio operate? What is your credit like? What is your liquidity reserve? And especially right now in times like this where rates are increasing, lenders are looking to prove reserves for that type of liquidity for projects that are large. If you have a capital call on a 30-unit building and the boiler goes, do you have $100,000 to be able to fix that boiler? Overall borrower strength is definitely becoming more scrutinized when going through the CMHC process. You're going to want to make sure that you have all of your T's crossed and your I's dotted, as we said previously. Having strong credit, strong liquid reserves, a strong overall debt servicing portfolio, active income. If you have high active income or you have the ability to take on high cash flow from your portfolio, that's a great thing to be able to show a lender. So don't neglect your personal finances or your levels of debt just because you think that the qualification is based off the asset itself, because the strength comes from both the asset and the borrowers that are looking to take on the debt.
Another thing to consider with CMHC financing is the appraisal. Two structures here. If your building is 24 units and under, you have to order your own appraisal. If it's 25 and above, you don't necessarily need to order an appraisal. CMHC will just do their own internal valuation. Now on these smaller, 24 and under type buildings, one thing we got to keep in mind is what levels of market rent are your leases at. So CMHC, in conjunction with the appraisal that you get done, is also going to do their own internal valuation. CMHC, when they're considering your appraised value, they're going to want to make sure that the rents that you're using are within market norms. So, if you got a 10-unit building and it's all 2 bedrooms and market rent on a 2-bedroom is $2,200, but you're using $2,800 on all your leases, chances are CMHC is going to not accept your appraisal, and they're going to normalize the leases that you have back down to that $2,200 mark and revalue your building there. Now, what this is going to mean is that the loan size that you're going to get, if you're at, best case 95% loan to value, and let's say you want your building to be $2.5 million, maybe they bring that loan size or that value down to $2.2 million, and you're going to get 95% off that, and not the 2.5 that you had on your appraisal with these market rents that were way above market averages. Again, same thing on the larger size, 25 and up. If you don't get an appraisal done and you submit your rent rules and you're hoping for a value, CMHC is going to take a look at that. They're going to figure out what the market rents are in the area. And again, if you're way out of line, they are going to bring down the value on their internal valuation, and that's going to be the valuation that you're stuck using. So just keep that in mind when you're running your numbers and you're trying to figure out your takeout financing, and you're using these huge values. And that's great that you can get those on your leases, but from CMHC's eyes, because of their mandate in affordable housing, they still want to see that you're keeping these values within market norms for the rents.
Yeah, one of the main advantages of taking on CMHC debt is the increased amortization. One of the CMHC killers that we see on an application is a factor called remaining economic life. Now, this is really important if you're looking to determine, how long your building is going to last for, based off the current condition that it's in. So MLI Select obviously has this big flashy, slogan, 50-year amortization, 95% loan to value. People love it, but unless you're building a new building, this probably isn't something that's going to be reflective of the current economic value of your asset. So hear me out. Here's how it works. The CMHC will only give you an amortization 5 years less the absolute maximum remaining economic life of your building. The average brand new building is 55+ year remaining economic life. So if you have a 70s built 3-story walk-up, unless you've completed significant full renovations to this building, we're talking roof, windows, absolutely everything you could, the remaining economic life probably isn't 55 years. So, some of the challenges that we've seen some people, through the submissions go through is the remaining economic life just doesn't necessarily align with their amortization requirements or their expectations. So there's understanding that when you are going to start this and we do have an appraiser go out, or we have, an environmental team go out and assess the remaining economic life, we're going to first understand what is it right now and then what is it when the project is complete, just to align with your current requirements or expectations of your amortization. Getting a 55+ year amortization on a pre-existing building can be challenging. Most of the time, Erin and I are running our numbers at 40-year amortizations, and if you do get 45 years, obviously it's a bonus, but keep that in mind when you are looking to submit a file, that understanding the remaining economic life of a pre-existing building should have your amortization a little bit lower than that 50-year mark.
Another thing to keep in mind is how CMHC calculates expenses for their building. So they have actually 3 sets of expenses. 2 of them are based off of a wood frame structure. The last set is based off of a concrete structure. It's important to note what kind of frame is your building based off of. The concrete expenses are substantially higher than your wood frame expenses. And if you're working with a broker that doesn't understand this, he might be running, or they might be running the expenses just based off of the wood expenses. And if it comes back that your building is actually a concrete frame, your debt servicing is going to be out of line. So if you're looking to go from start to finish, reposition to exit into CMHC, you want to make sure that you at least know ahead of time what the framing is, or be running the expenses based off of the highest concrete just in case, to give yourself that buffer, and then verify with the appraisal if you're not able to figure that out ahead of time through the realtor or through the seller. Keeping that in mind and just making sure you're buffering your expenses is going to make sure you have your best chance of success with your highest takeout exiting into CMHC.
As you guys can see, this isn't the most easy type of financing to understand. It can be decently complex, and it's very specific to the location, type of project, and how large it is. So if you guys have any questions about your specific building or a project that is coming up, feel free to reach out to Erin and myself. And we're experts at this. We do this all day, every day. If you have any questions, reach out. We'll run the numbers for you. We'll take a look at your pro forma. We'll make sure that your projections are accurate, and we'll put you in a situation to be able to execute effectively on your project. If you got a lot of value from this video, please hit the subscribe button, hit the like button. It allows us to create more content like this for you. We're really looking forward to making the next video for you guys.